We continue to track what's happening in the stock markets globally, and U.S. futures continuing to indicate a negative start to this trading session. Of course, with that massive sell-off that we saw yesterday, a lot of people started asking the question, are the machines taking over, the computer trading? Our next guest says yesterday's sell-off was driven by computer program trading, much like the flash crash of 2010. Scott Bauer is the CEO of Prosper Trading Academy, and he joins us now from Chicago with his take on a wild afternoon. Why don't you break it down for us? What exactly were you seeing and hearing, and why do you think it was ultimately the machines taking over?
Well, we saw the continual slide throughout today, but it was not, with the enormous velocity that we saw that last hour of trade. So at 2 o'clock East Central Time, or 2:10 Central Time, the Dow was down about 450 points. We saw S&Ps down what they were. And then all of a sudden, rather than, seeing the market move in increments of 5, 8, 10 points, all of a sudden you started seeing 50 ticks at a time, 100 ticks at a time. We went down 600, 800, 1,000, 12, 13, et cetera, et cetera. So something kicked in at that particular time. And at that same time also, while that was happening, we saw that last massive spike up in the VIX. Yes, the VIX had been rallying all day. In that same period of time, though, we saw that last massive spike up. And then all of a sudden, that lasted for, 8, 10 minutes or so. We saw the Dow come back 700 points in a matter of moments, from down, 1,500 to down about 800, till eventually, that's where we settled in. So that period of time there, that is where the machines really kicked in and took over the marketplace. Now, could that have been a precursor of what was, yet to come in the overnight session and what we're seeing today? Perhaps. But that's what had everybody turning heads yesterday in that last hour of trade.
I guess, what is the significance of that storyline around computer trading, though? Because if we look at our everyday life, technology rules everything now, right? Most advertising, for example, that you'll see is driven by searches on Google and other means. It's an evolution. Trading has evolved because of technology. Isn't it the norm to expect that the computers are going to be calling the shots at the end of the day?
John, unfortunately it is. It's the nature of the beast. Like you just said, that's what technology is. We have to take the good with the bad. But, when you're in a time of, let's call it, panic, when the investor on the street is in a time of panic trying to reach his broker saying, oh my God, I got to get out of my long winning positions that are still up 25% over the last year, get me out, and you can't do it, that's where some of the, feeling of nausea comes in for Main Street. Now, as a professional, as a trader on the floor, and you kind of realize what's going on, it doesn't help the situation because the liquidity during that period of time really almost goes away. As much as electronic trading provides liquidity, when we get to a point like that, it almost takes it away. There is no liquidity.
Okay.
So again, it's almost, you have to take that step back, digest what's happening. I know a lot of people don't have the stomach to do that, but that's what's going on.
All right, I want to talk about this issue of volatility. You mentioned the VIX, which is a measure of volatility, and we showed our viewers a chart of volatility. Now, I always joke that isn't the stock market volatile? Stocks go up and stocks go down. Why do we care so much about this chart, which at the tail end of it, all of a sudden has spiked up to indicate that there's a more volatile market? Can you walk us through the significance, the importance of that?
Sure. So if you think of the VIX as your insurance policy, you have an insurance policy on your car, on your house, on your personal articles, whatever it is. This is an insurance policy, and it comes down to the basic principles of economics. This is what I teach people. It's supply and demand. So when the market is just kind of steady, going up, going down, we're seeing, minimal fluctuations throughout the day. It's cheap to buy protection. But when something like an event happens over the last couple days, and all of a sudden everybody out there in the marketplace runs to lock in their profits or, quite frankly, get out of their profits, well, it's supply and demand. The supply all of a sudden shrinks, the demand for this insurance increases, and that's why we saw yesterday not just the VIX itself pop almost 100%, but if you look at the volatility of the VIX, which is something people don't really key in on. Look at the volatility of the VIX. off the charts yesterday. Now, John, something I want to point out. We saw over 3 million options trade yesterday in the VIX. But that being said, the call-put ratio was about 4 to 1 yesterday. Typically on any given day, we'll see that ratio at about 2.5 to 3 to 1. So the amount of options traded yesterday was off the charts, most we've ever seen, but that ratio of call to put wasn't so excessive, in my opinion.
Okay, and calls are options to buy the market, puts are options to sell the market. Scott, we've only got about 20 seconds left.
Okay.
Do you think that we're in a new period of these wild swings, more daily swings? We just saw the market going up, at least in the U.S., basically for 12 months. Now that people are trying to digest interest rates, all that kind of jazz, is this the new normal for wild moves in the market?
You know, it's the new normal over the next month or so. I think come summertime, come end of year, we're going to look back and say, you know, wow, look at that chart. We had this, you know, huge blip, this huge aberration, you know, in the marketplace. And I do think as we progress through the year, as interest rates settle down again, we'll be back somewhat to the norm. We're not going to see VIX down below 10 anytime too soon, but I would expect it to be back in the mid-teens sooner rather than later, probably in the next 6 weeks or so.
All right, Scott, thanks for breaking it down for us this morning from Chicago. Scott Bauer, the CEO of Prosper Trading Academy. And Scott, provide a little bit of context there. Up next in our chart attack, we'll have a little context on the Dow drop. The weakness we have seen yesterday and over the last week versus the performance from that U.S. benchmark over the longer term. Stay with us here on Business Day.